All right, guys, I want to welcome you to the January 2026 State of the Market Economic Update. And as you know, we do these every month to keep you up to date on what's happening in the industry, the economic indicators that are affecting housing. And we want to make sure that you understand how to be able to make sense of all the data. And we pour over the charts, we pour over the daily reports, the headline numbers, and our goal here today is to make sure that we can help you understand how to read the tea leaves in the market at a milk and cookies level. And again, we try to keep this as simple as we can. As always, if you have questions, don't hesitate to put it in the chat. Kennedy and McKenna are moderating, and they will be happy to pause me and let me know that we have something that we need to talk about. So with that said, I will share my slide as we have a few people coming in, and we'll get started. You guys, you're able to see my slide, is that correct? Great. All right, let's dive in. It's hard to believe it's almost 3 weeks through January already. Okay, as you know, I am the operating principal for the Bay Coastal Living offices and the Coastal Living Collection. So if you need anything, that is my contact information. And of course, our mortgage partner is usually on this call, and yet today he is actually making a presentation at another office. So if you do not already have the Echelon IntroLend app, the QR codes for iOS and Android are on the screen. That app allows you to fast track your customers, and that sends them through in a very simple format and make sure that you can send leads earlier in the process, and you've got Homer and the concierge team working those leads on your behalf. They're assigned to you, so we know that that lead belongs to you. Their goal is to help get that customer financed or moved through the process and then hand it back over to you to be able to go find a property. So if you haven't met Homer, let us know. We'll be happy to make a connection. So let's talk about what has happened since the last call. And I feel like every month for the last 4 or 5 months, I've said this, there's just been a barrage of economic data, a barrage of policy that affects housing specifically. And the good news is that we've been almost the watched pot that would not boil for quite a few months. And all of a sudden, there's a lot of signs, and in fact, a lot of signs of hope. And in fact, when we look back, we really start to see that since June of 2025, we're starting to see a little bit of a housing recovery. Rates have come down. There's a lot of good economic data out there. So we're going to walk through that. So let's just touch on a few of the headlines that matter. First of all, as you know, in December, the Federal Reserve did cut the federal funds overnight rate. So it was a 25 basis point cut. That helped to stabilize the markets, help keep bond yields where they're supposed to be, and that impacts mortgage rates. Currently, we're only expecting maybe 2 or 3 additional cuts in 2026. So that's probably going to keep a lid a little bit on how low mortgage rates can go. And yet we're sitting at 5.75%, 6% on pricing. So we're actually really back to really good interest rates again. Now, President Trump, he's getting ready to announce Jerome Powell's replacement, and this has been the slowest moving fast train that we've reported on in a long time. We expected him to make this announcement 3 or 4 months ago to create a shadow Fed. Of course, Jerome Powell and President Trump, they've been locked in a battle of wits, and the president wants to see rates lowered more aggressively. The Fed is a little more conservative. They're watching labor, they're watching inflation. And so they've been kind of at each other's throats. It's looking like maybe Kevin Hassett is going to be the new Fed chairman. That would be good for the markets. He's a calming influence. He is a pro-Trump policy administrator, and yet he's a little more on the neutral side than some of the other suggested candidates. So we'll watch that. In November, December, you heard some talk of going to a 50-year mortgage. Kind of crazy that we'd be talking about a 50-year mortgage. That was a trial balloon that got put out there, and it sounds like that got kind of squashed. It was not well received by the market, so it looks now like that's probably off the table. There's also a proposal that was made in the fourth quarter for portable mortgages, which meant you'd be able to take a mortgage, have it, and then move it to your next home and maybe somehow bridge the difference. The markets did not respond very well to that, to be candid, and it looks like that one's probably going to be off the table now at this point also. Now, the new one that just came out this week was a proposal to allow home buyers to use their 401ks to be able to have that as a source of down payment or a funding source. And that is, so far, that's actually gaining a little bit of traction. There's some positive momentum behind that. And that would help, especially first-time buyers, first-time move-up buyers, to bridge the gap in the affordability that we have. And of course, the appreciation rates the last 5 years have outstripped earnings. And so it's been harder and harder for consumers to be able to afford the housing payment. Inflation continues heading in the right direction. We're still not back to the 2% trend line that the Fed wants to see. And yet, when you look back and you see that we were at over 9% interest at one point, we've come down a long ways. We're running in the 2.5 range currently, and we'll talk a little bit about that here in a minute. The tariffs priced in a one-time increase in inflation, and the good news is the tariff policy hasn't kept inflation overly high, so that's been a positive. We're going to touch a little bit on what's happening in the 10-year Treasury. Of course, the 10-year Treasury is what actually tells us where interest rates are headed, and we've had some crazy world events the last few months. We bombed Iran, we took out the leader of Venezuela, and through that, shockingly, the 10-year Treasury has stayed in a very tight range of about 3.9 to 4.2. That's an indicator that traders are happy with where the economy is. They're comfortable with the world order. There's not a lot of surprises happening, even though you'd think some of those would be surprises. But calm and steady is positive for the housing market, and it's helped to bring mortgage spreads down. And so we're going to talk a little bit about where we're sitting now. Mortgage rates are at 3-year lows, so we've dramatically improved over the last few months. And again, spreads have gotten better, and now we're at 4-year lows on the mortgage spreads, which is just the difference between the interest rate and where the 10-year Treasury is. Existing home sales finally are on the rise, so we're coming off the slowest sales pace in U.S. history, and now we're headed upwards. And along with that, we're seeing mortgage purchase applications starting to be in the double-digit range. So we've got a couple of weeks of data. Anytime we get interest rates at 6.4 or less for what we call duration, which is usually about 12 weeks, you'll see purchase applications ticking up, and that is coming true. And then lastly, Trump has announced a few policy initiatives to support housing. So I'm going to go over a couple of those right now. This just came out just this last week. There was an executive order aimed at restricting large institutional purchasing of single-family homes. Now, there's a lot of hubbub out there about large institutional investors buying up all the housing stock. And the reality is that the large institutions predominantly only own about 1 to 1.5% of the housing stock. However, single family investors that own less than 4 properties, I believe, are over 40%. So it's really more of the mom and pop investors that just have rental properties that own these. And yet it's a little bit of a shot across the bow, and it maybe is more of a gesture than a really true change, but we'll watch that and see where that goes. January the 16th, President asked Fannie and Freddie to spend an additional $200 billion buying mortgage-backed securities. That further stabilized the market, and $200 billion is a small number in the grand scheme of things. But again, it's a signal that Trump really wants to make sure that housing policy is at the top of his agenda, and that interest rates come down. He's working to bring energy costs down. All of that brings inflation down, and then that would in turn bring federal funds rates down. Now, we do have some interesting drama still between Powell and Trump. So we have the nomination coming up, and of course, this week the Supreme Court will hear the case on Lisa Cook. Trump attempted to fire her because of some mortgage papers that were not maybe potentially truthful. That has gone all the way to the Supreme Court, and just last night there was some indication that the Supreme Court was not going to allow this to happen, but it remains to be seen. So depending on the outcome of that, between Fed governors that are headed out, being fired, and then the replacement of Jerome Powell that'll happen sometime between now and the end of May, that would give a 5-2 majority on the Fed towards Trump policy. And again, that's a push towards reducing rates faster and further. So let's just take a look at where we are currently in the 30-year fixed rates. Today, we're sitting at 6.2. We actually hit a 5.99 last week. So we're bouncing in that low 6 range. 15 years, 5 3/4. Of course, Echelon, we're getting a lot better rates than this. This is a national average. If you look at Jumbo, 6.38, and then a VA is about 5.9. Now, it's been a little while since we've seen a 5 handle in interest rate, so that's really exciting. And that's an emotional trigger for buyers when they see the 5s. It really tends to pull them back into the market. We're starting to see that in mortgage purchase applications. Okay, so if we just look at, and McKenna, I'm going to make sure you are admitting people as they come in, if you don't mind. If we look at 30-year mortgage rates, and we just look at where we've been over the last few months, we entered January 2025 at a little over 7%. May, we had bounced down, we bounced back up. October, we started to see things improve, and you can kind of see that trend downward that's been happening ever since that June, July, August, September timeframe. So when you see this, you realize how much the rates are improving. And then if we zoom out and we look at this on a 3-year timeline, we start to see some of the key moments in time. October 25th, 2023, we hit 7.79. That's when the 10-year Treasury was at almost 5%, and mortgage spreads moved from about 1.5% to 3%. And that's where we got almost 8% interest rates. We fell off that through 24, and then of course in May of 2024 we hit 7.17% again January 16th this year. Now you can see that slide downward, and this is a combination of the federal funds rate's been cut, bonds, the 10-year Treasury has fallen, and mortgage spreads have gotten better. And I'll show you where those are currently. And yet, if we look back at a 5-year, you can kind of see where we were headed into COVID. And, September 20th, 2020, we hit the all-time low of 2.9%. So when you see this and you think about the 25% increase in property valuations that we saw during this period of time, coupled with a change from 3% to almost 8% interest rates, you just really get a picture of an affordability challenge that we're all still kind of suffering through. Now, if we look at the same data and we look at this on a historical trend line, so this is the all-time history of the 30-year fixed rate mortgage, you can see we're still bouncing at or around the long-term trend line of about 8%. So anything below 8 historically has been a good interest rate. And I do remember, I remember in the 90s when we got from 10 to 9.875 in our office through a party because rates were now in the single digits. So when you think about 5, 5.5, 6, those sound like really, really good rates. However, our consumers just got used to 2 and 3% rates, and that's where we've just had to wean them off that low payment. Of course, we hit the all-time high in U.S. history, October of 1981. That was a period where we had a lot of inflation happening. We were coming off an oil crisis, and rates were at 18.6%. But I think the important thing to remember is at every point on this graph, homes sold. Now, some years more homes sold, some years less homes sold, but on average, there's about 4 million minimum homes transacting every year. So there's more than our fair share to be able to go take those. We just have to work harder to find those consumers. So that's a little bit of where interest rates are. When we look at employment, the employment is one of the two really main figures that the Fed looks at when they determine fiscal policy, Fed fiscal policy. Typically, they will look at labor over inflation, and the Fed has two goals. It's to maintain maximum employment, and it's to maintain inflation at or near 2%. That's the growth. And if you think about it this way, if appreciation is happening every year at 3 or 4%, the economy is growing at 3 or 4%, wage growth is in that 3 or 4% range, and inflation is at 2%. What that means is that every year people are making more money, they've got more disposable income, the economy grows, and that gap starts to be where affordability happens. When you flip that on its head and we look back the last few years when we were at 9% inflation and we had wage growth that was extremely stagnant, again, that's where we got the affordability issue. So it's labor and it's inflation the Fed really looks at. Now, we're at a really weird time in the labor market, and some of this has to do with the fact that we've reduced the number of people entering into the country. The borders are closed, so the workforce that was really expanding rapidly has slowed down, and that's put us in this period of time where the Fed has indicated that potentially 30, 40, 50,000 new jobs created monthly could be a normal thing, and that potentially zero job creation might not even spook the Fed. Now, historically, we'd expect to see 180, 200, 220,000 new jobs created each month, and that's where we're just in this weird low job creation and low firing, which is kind of interesting. We don't see as many employees being fired or taken out of the payroll. So if we look at this in December, there were 56,000 new jobs added. It was projected to be 60. November got revised downward, and October got revised massively downward. So in October, the economy lost or shed 173,000 jobs. Now, there are some of those that were the federal workers that were released early in the year, finally showing up in the job data, and yet that was a pretty big revision. So overall, 2025 added 584,000 new jobs to the economy. And if you just contrast it to 2024, we were about 2 million. So we're just in a weird labor mode right now. Now, if we look at this just in chart format, you start to get a little bit of a sense of what this looks like. Each one of the lines, the taller the line, it means the economy created more jobs in that period. And as you notice, September 25 into May of 26, you start to see that slowdown happening. And now you see these months where we have negative labor growth, which means we're getting rid of jobs faster than we're creating them. So the Fed's watching that very closely. They will typically look at labor data over inflation data, so they'll tend to weight labor more importantly. And this is where the Fed's just in a little bit of a wait and see mode to see what's going to happen, where are we headed with this. If you look at this on a 5-year, you start to really get a sense of the trend line. And the reason I show these is being able to see the trend of what direction things are going. That's important for you to understand what lies ahead. And you can see how that trend line is just since 2021 continued to go down. So the economy is just growing. We're still growing, but we're growing jobs at a slower pace. Inflation. Inflation's the topic that we all talk about, and that's what inflation's what makes us feel like things just cost more and it's more expensive to live. And it's important we talk about a couple of different kinds of inflation. The CPI, which is the Consumer Price Index, that tracks what we call a basket of goods, and it's all the things that we take to live each month. Now, core CPI takes out the two really volatile parts of the CPI, which are food costs and energy costs. Now, of course, the Trump administration has made a concerted effort to bring down energy costs to reduce the cost of oil, and that has helped bring overall inflation down. So when we talk about CPI or core CPI, we just have to be able to take a look at which is which. The Fed watches core CPI a lot more closely because it's sticky. When things other than food and energy go up, they do not tend to go back down. And so that's where core CPI is important. And then, of course, we have the producer price index, which is really how much does it cost for a manufacturer to take all the input costs and make something. So if we look at this in December, core CPI was up 2.6%, which means inflation as a organization or as a country was up 2.6%. We expected 2.7. That's the lowest since March of 2021. And so we are headed in the right direction. We're still not at the Fed's rate of 2%, but we're getting better. December CPI was at 2.7, so not a lot different, and that's an indication that energy and food costs have kind of gotten a little bit under control. Again, the lowest since 2021. So it's good to see these new benchmarks coming down. The cost of tariffs have really kind of peaked. So the impact of tariffs, it's bringing a lot of money into the Treasury, and it hasn't overly contributed to inflation as was concerned or was the concern. So we expect inflation to continue to trend lower, getting back towards that 2% line, which is where the Fed wants it. If we just kind of look at this on a historical basis and the trend line, you can see where we were over that 9% inflation rate, which is just crazy. And you can just see how that has continued to fall. And as we've gotten into the latter part of the year, of course, we have a month missing from the government shutdown, but we're at 2.6%. We're getting back to healthy markets. That's good. If we look at this on a 10-year horizon, you really get a sense of how crazy fast the economy, as we were printing money, really the costs increased. So that's the post-COVID and the COVID bubble, and now we're coming off that. And you'll notice right there at the end, you're starting to see that leveling off, and that's really good. It's good for consumers. It's good for the economy. It's good for the Fed. It's good to see that will help bring those federal funds rates down to a more accommodative position. And if we just kind of look at the CPI headed into it, this is the index. So this isn't the year over year change or the month over month. This is just how much more expensive did everything get. You can just see that we've been on an increase. Okay. Unemployment, we talked a little bit about this. December, the unemployment rate in the US was 4.4%. 4% is pretty much considered complete employment, full employment. So when it comes to the unemployment rate, we're at a really, really healthy number. And this makes the economy look like it's almost running hot. November, we are at 4.5%. That was the highest since 2021. And we're expected to spend most of 2026 in that 4 to 4.5 range. So when you see this, you can kind of see the 1 year at a little bit of an increase. This felt like maybe we were headed into a increasing unemployment market, and yet that hasn't shown up yet. Now, this is one of the charts that just shocks me when you look at unemployment going back into the pre-COVID and the COVID period. You start to see how much the economy was impacted from the shutdown. But as you look at that 2023 to 2026 trend line, you can just start to see that unemployment is growing. And again, this is something the Fed's watching really closely to see, is this a slowdown in the economy? Is it a return to a more healthy market? Kind of remains to be seen. Now, speaking of federal funds policy, the markets are currently pricing in and expecting somewhere in the neighborhood of 2 to 3 additional rate cuts. Those are probably going to be a 0.25% rate cut each time, or 25 basis points. The key driver or the key indicator that they're going to be watching is, does labor market continue to soften? If it does, you may see an additional rate cut in there. If it doesn't, it's possible we could be 1 to 2. But currently, there's a 27% chance of 3 cuts for a total of 0.75%, and a 24% chance of 2 cuts. So odds are pretty good. We're over 50% that we're going to see 2 or 3 rate cuts next year. Now, the reason that matters is The federal funds rate isn't directly related to 30-year fixed rates, but there is correlation there because it impacts the bond market. So if we look back at the federal funds rate in the post-COVID era, we had in this run-up right here, starting in June of 2022, we had the fastest increase in federal funds rate in US history. The only time it happened in a similar pattern was in the 80s when inflation was running out of control. And we saw that chart earlier. Now, when you look at this, you start to get a sense of how we've kind of been in this like really slow, not very reactive pattern. And what I mean by that is we hit the high of 5.5% July 30th, 2023. And this is the rate that banks charge each other on loans overnight. We started to cut, so we went from July of 2023 all the way into September of 2024 without any rate cuts. That's when we started to see a couple rate cuts. We saw 3 cuts in 2024. And then between December and September of 2025, nothing. It was just slow and steady. We expected more cuts in there. I think that the economy would have liked to have seen more. And I know that the Trump administration pushed very hard to try to play bully ball with Jerome Powell to get him to cut. And then, of course, in the fourth quarter, we did have a couple of cuts, bringing us down to 3.75 with that last December cut. But that gives you a sense of how fast things changed and how slow they've been to come back down. Now, I'm going to share the dot plot. This is sort of all the Fed governors. There's 19 of them. Each quarter, they put a dot where they expect the rate targets to be for the next year. And again, this is the federal funds rate, not mortgage rates, but we'll show you how those connect together. And so the December dot plot gave us some interesting information here. And it's anonymous. We don't know who was who, but you can kind of guess on a couple of these as to who's who. There are some Fed presidents that are very, very hawkish, that like they would like to see interest rates raised currently. They think the market's too hot. And there's a couple that are highly aggressive at wanting cuts. And so at the low end, you can kind of tell, here's the one, we probably know who this is, and we probably know who this is. But when we look at this for 2026, there were 3 that indicated a rate increase, that they thought rates should go up. There were 4 that thought there should be 0 cuts. There were 4 that said they should have at least 1 cut. And there were another 4 governors that said 2 cuts. And then there was 1 that said 6, which is comical. That individual, by the way, is probably positioning to try to take over Powell's post. So we're seeing it's probably in the neighborhood of 2 to 3. Now, it's interesting because when you look at 2027, there's 6 that believe we would be at 3.25%, which means that would only be maybe 1 rate cut between now and then. So it looks like the Fed itself, they're being a little bit hawkish, and they're not moving towards an accommodative stance. And accommodative means that they would be reducing rates to spur the economy. So when we look at how that impacts the mortgage industry, the last 20 days, the 10-year Treasury has been trading somewhere between about 4.1 and 4.25 this year. Again, I said that's a really stable range, especially considering that we've had Venezuela issues, Iran, other world events. And it's important to know, and I'll show you the graph on this, but anything below 3.8% on the 10-year Treasury would indicate that the bond market thinks that there are some recessionary levels or some recessionary signs. So the fact that we're in this range, it's a good thing. The markets are steady. They're happy with the way things are humming along, and they're not highly reactive. And that's where we've started to see the spreads really get back to normal. And this is where we think mortgage rates are headed, 5.75, 6.25 for much of 2026. So if we just look at that 10-year Treasury, you kind of get a little bit of a sense of what's happened over the last year. April 4th, Liberation Day, the day tariffs were announced. Of course, we saw a massive sell-off, and bond prices went down a lot. Now, a couple of other key notes October 22nd, that's when we started to see some really, really weak job data going into the fourth quarter of 2026. And then, of course, we had this little anomaly last week, which was the Japanese bond market did some weird things, and that impacted us. But that wasn't really based on U.S. events. That was overseas events, and it kind of spooked the bond traders. But they're back. So we're sitting at 4.2%, which is really healthy and where we want to be. Now, if we take a look at the 10-year history, I show this graph to show you how it came to be that we had interest rates at 2%. The federal funds overnight rate, basically we've got a zero interest rate policy in the 2021 era. And 2021 and 2022 era. And with that, the spreads were about 2% or 1.8%, and that's how we got 2.5%. Now, when we see the run up, we got to July of 2023, we saw over 5% on the 10-year Treasury, and then you can kind of see where that's fallen back down. All of that is to say, this is what directly influences the mortgage rates through mortgage spreads. And of course, the rates are what influence buyers' activity. So with that, when we look at historically the difference between where the 10-year Treasury is and the 30-year fixed rates, typically about 1.7, 1.5, 1.8%, somewhere in that range, which means that if a 10-year Treasury is at 4, you expect to see the interest rate about 5.8, 5.5 and 5.8. So this is where when our consumers hear that the Fed cuts interest rates, they think that it automatically translates into 30-year fixed, but it does not. Only about 40 to 45% of the 30-year fixed rate, or about 60% of it is the federal funds rate. The rest of it is the 10-year Treasury. So if we look at this on a graph, this shows the gray line is the federal funds rate. And I always show this just to illustrate what the mortgage spreads are and why they matter. But that gray line is the federal funds rate. So that's the rate that the Fed charges for the overnight bank rate. The red line is going to be your 10-year Treasury, and the blue line is your 30-year fixed rates. And if you notice, they do what we call the slow dance. They just kind of move right in correlation with each other. There are some times that the spread or the space between those two lines are very close, and that means the spreads have gotten small. There's other times when the spreads get a lot bigger, and at this period of time, this is when we saw almost 8% interest rates because those spreads got to about 3%. So understanding how that correlation matters helps you be able to understand when the Fed cuts, how it can be that the Fed can cut and rates sometimes can still go up. So if we look at where we are today on mortgage spreads, this is a absolute gift to our industry. The 10-year Treasury is running at about 4.25. Yesterday, 30-year fixed were at 6.06 on a national average, which means we're at 1.8 on a spread. That brings us back in that 1.5 to 1.7-ish range. So spreads are the best in nearly 4 years. And the last time we were this low was January of 2022. So with that in mind, we're really in a good spot going into 2026 with improving spreads, with a stable bond market, with energy costs coming down, inflation coming into range. This is setting us up for a much, much better 2026 and probably a really, really good 2027. So if we just look at what's happened, I showed this slide last month. If we compare the beginning of the year last year to the end of the year, you can see that the savings on a typical 20% down mortgage at the median price is about 10.4%, which means the buyers have 10 to 12 additional percent purchasing power, means their dollars go further. And that's where we're starting to turn that corner on affordability and catching people up on the overall cost. In other words, the cost of the monthly payment is coming down. Now, all of that translates into existing home sales. And existing home sales is just the pace at which the resale market or existing homes transact every year. And so just to give you a sense, there's about 92 million existing homes in the US currently. So on a typical year, we see somewhere between 5 to 6% of homes transact. And if you think about it in this way, this is where in your database, we talk about for every 100 people in your database, you'll get about a 6 to 10% rate of return. And this is where that number comes from, is roughly 6 to 10% in any given year, depending on it being a slow year or a fast year, are going to transact. So what that means is that at 4.1 million home sales, which is the level that we've been bumping down against, we are absolutely at the minimum number of transactions that we should be seeing, which means there's nowhere to go but up. So that's the good news. We're probably not going to go down any further. The demand didn't disappear. It's just participation was suppressed. So now that participation is coming back in. So if we look at this on a graph format, we take a look at 3 years. You can kind of see where we hit some highs. February of 2023, things were still humming. We were at about 4.46 million. And boom, we fell off. We felt that. June of 2022 is really when the slowdown really began, and we start to feel that in the sales pace. June of 2025, we hit one of our lowest levels in a while, 3.93 million seasonally adjusted. And as you start to see that trend line coming off June, you're seeing that increase. That's where we're starting to see consumers moving off the sidelines, moving back into the market. And as long as we see interest rates remaining stable with where they are, we don't see any big fluctuations in the bond market, which probably means no major economic or world calamity type news, wars, those types of things. We're going to continue heading in this direction. So that pace is solid. Now, to give a little bit of a sense of why it feels so tough right now, this chart shows the last 10 years of existing home sales. And you can see in that 2016 through about 2020, we were in that roughly 5.5 million sales pace every single year. So year in, year out, 5.5 million. That's a really active market. It's a good place to be. Of course, we cratered with COVID, and then the crater turned into an absolute avalanche of transactions. We went from 4 million to 6.6 million. And of course, that's the time that we remember when there were 30 offers on every listing, and it was a crazy time. We then fell off as interest rates climbed to all-time highs, and that left us at a basically 4 million in January of 2023. So you can kind of see we've just kind of bounced around off that. 2026, we're going to expect to be in the mid 4 million range. So it's going to be an increase. And then 2027, 2028, we're looking at probably 8, 9, 10% increases. So we're getting back there, and yet it's not as fast as I know any of us would love to see it. Now, if I go to the next slide, we look at 2026 projected. So last year we ended the year at almost 4 million, basically right on the dot. 4.44 million is the projection for this year. That'd be a 9.4% increase. 4.71 in 27, which would be another 6.1% increase. And Fannie and Freddie were projecting about 7.8. So either way you slice it, it's going to be a better year. There's going to be more homes transacting, which means more transactions per agent. If we look at where do we think rates are going, we're still looking at somewhere in that 5.75% to 6% in the first half of 2026. It's possible that with spreads getting a little bit better and that labor market softening, which it looks like it might continue to do, we may see something in that 5.5 to 5.875 range in the second half of the year. And of course, that would continue to accelerate it. It's a little bit sad to say, but if we have some soft labor data, which means the labor market may not break, but means people are losing their jobs, it would be good for the housing economy. And that sounds odd that people need to lose their jobs to spur on housing, but that would cause some policy shifts in rates that would help us out. And when you think about the fact that housing is 17% of the US economy, we represent a large chunk of the economy, and yet we've been one of the very few industries that's been in a 3.5 year recession. So we've paid the price while everything else has gone up. Mortgage purchase applications are up 14.1% over the previous week, and it extends a 28.5% increase from the previous period. Again, mortgage purchase applications are an indicator of people moving off the sidelines, applying for a mortgage, and that eventually turns into pending contracts. So we're at the highest level since February 2023, and you start to see a trend that there's a lot of highest level since 2022, 2023. This is all a good sign. And if we just look at this on a graphical format, you can kind of see we had September of 2025, when rates had fallen, we saw a big increase, and now we're back in that spot. The catch is rates fell and they went right back up. Right now, it's looking like rates are going to have fallen and stay a little bit more consistent, so that's good. And if we just look at this on a 3-year, this is the mortgage purchase index, the Mortgage Bankers Association, you can just see the trend line is moving up. That means more and more people are starting to come off the sidelines and do mortgages. One other item I wanted to just share with you, and this is kind of weird because, again, we're in this really low job creation and low job firing market. Initial jobless claims is another indicator that we track. It just tells us who got laid off, and it comes out every Thursday. And it's tracked by the new people that are filing for unemployment benefits. We're currently trending pretty consistently at about that 200,000 a week claims data, which is extremely low by standards. So again, we don't have a lot of jobs getting created. We don't have a lot of jobs being lost. It's very unusual time by historical standards on that. And if you see this, you can really kind of see where the last 12 months has just been, we've kind of dropped off a little bit of a cliff in terms of the new jobless claims. We look at this on a historical level. You can see what happened during COVID when everyone lost their jobs and then got rehired into the workforce. And you can kind of see it's been a little bit consistent, although there has been a little bit of an upward trend line. It's just the last few months now are headed in a little bit of the different direction. So let's take all that and let's look at what's happening in our local housing market. And there's a couple of interesting trends that we're seeing in here. So we're going to start with Charlotte County. These are the pending transactions year over year. So new transactions this year over last year. So 2025, we are running above 2022 and 2024 levels, but we are not above 2023 levels, which is a little bit interesting. So we're going to watch that closely and see what happens now that we're into season with rates a little bit lower. Charlotte County is still a little bit of a saturated market down there. We're seeing days on the market pretty far out, and I'll show you what that looks like. So Charlotte's in an interesting position. Sarasota County 2025 is finished the year above 23, 22, and 24. So Sarasota continued to surge forward and is really doing the best of all three counties in terms of the sales pace and new pendings. And if we look at Manatee County, I really had to deep dive this one a little bit. Manatee County pendings, they're above, well, they're actually at 2024 levels, but they're still below 2022 and 2023 levels. I think what's happening here is we have a little bit of a demographic and a little bit of an economic difference in the buyers that come into Manatee County versus Sarasota County. Sarasota has a little bit more of a mature population base and a little more of a tendency to be less rate sensitive and less payment sensitive, where Manatee has a lot of first-time buyers or first-time move-up buyers who are probably at an economic level that are a little more impacted by rate sensitivity. So I'm going to keep watching that, but this is an interesting trend where you see two counties that are right next door to each other starting to trend a little bit in different directions. Now, here's the money slide for you guys this month. This is the market dynamics. And actually, this one says 10-1, but I actually updated this month. So I'll make sure I correct this when I send this out. But in December, homes that were properly priced when they hit the market sold for an average of 95.4% of their list price in an average of 28 days. So less than 30 days and 5% off list. If the seller wanted to test the market and missed the mark on pricing, the average sales price to the original sales price to the original list price was 85%, and it took 142 days on the market. So this is where using your Shift Tactic 7 conversations, really helping them to understand why if we hit the market right, we're going to get a really strong price that's going to sell really fast. If we miss the mark, it's going to be painful because 142 days, and that's 4 or 5 months of having to leave the house, having to take the dog, put the kids in the car, drive around the block, go get ice cream, all those things. So use this in your listing presentations and in your pricing presentations because it will help you be able to show what's happening in the market and why pricing is so important. So let's zoom out a moment. Let's look at the national housing market right now in the United States. It's still overall a seller's market, and you've got areas like Texas and Florida where you're deep into buyer territory, and you've got other areas, particularly up in the Northeast and the North, where you are in deep seller territory, where there's still multiple offers happening. There's not a lot of inventory. So if we look at the median list price in the U.S., it's sitting at 419,000. The average days across the U.S. is 133 days. You have about 34% of homes that have taken a price reduction, which is right in line with historical numbers. And there's currently just under 700,000 total homes on the market. If we just compare this to last month, of course, in the U.S., it's cold up north. So you start to see the end of the year slow down. You start to see the relists slowing down, and people hold off until the spring market in February, March, April timeframe. So U.S. inventory was down 10.3% month over month, down from 775,000 last month to 695,000 this month. Median price is staying pretty steady, 422 to 419. And days on the market did creep up a little bit, which is typically in line with the winter season up north. We look at the condo market in the U.S., we're still in slight seller's advantage in the condo market. There's 195,666 condos for sale with a median list price of 365,000. Average days on the market, 152 days. So gives you a sense, condos are still sitting a little bit. When we look at condo inventory in the U.S., we're down 7.6% over last month. And again, that's people that pulled it off over the holidays. That inventory will probably return back to the market. And you're looking at about pretty stable median list price, not a lot of change, just typical wintertime numbers. So if we look at national inventory, and this is a really key number, in March of 2022, we hit what we call a savagely unhealthy market where inventory got so low that it was starting to be scary. So we hit 240,500 total homes for sale across the entire United States. Today, we're sitting at, as I said, about 700,000, and typically we would see 1.2 to 1.4 million. So the silver lining in everything that's happened is the housing market's gotten healthy in terms of inventory, and as sales pace picks up, about 8 out of 10 home buyers that come to the market bring a listing to the market. So that's how, now that we're in a stable housing supply in listing inventory, that's how we'll start to see an increase in inventory even as sales increase. So we're in a lot better of a position than we had been before. Yes, McKenna, you had a question.
Yes, I just see in the chat here, we wanted somebody to go back to the money slide a little bit and touch base if we had time.
Yes, we can absolutely do that. I will do that. I'll keep going and we'll go right back to that. Okay, average days on the market in the US sitting at 132 days. You can see how that's trending upward from the low of 54 days in 2022. When we look at properties with price decreases, long-term average is at 34%. We're sitting at 34.19%. So we finally have gotten back to a space where the number of price reductions is back to a healthy level. And that's an indicator that sellers have gotten realistic about pricing, and agents have gotten better at pricing in today's market, not looking back into the crazy run up. When we look at the number of properties relisted, we're at 10.4%. It's a pretty typical number off the low of 6.2% in 2022. And if we look at those median list price trends, I show this to show the the disproportionate changes between the upper tier of the market and the lower tier. And so you tend to see that upper 25% or that luxury market having a little bit more seasonality in their pricing. In other words, there's less consistency. They'll tend to overprice in the warmer months or the more active months, and then get a little bit more realistic in the off months. So this is across the U.S. You can just kind of see the bottom tier is about 209,000. The next 25 percentile is about 350, then 525, and then we kick up to about the million mark and above. Now, if we bring that down to Florida, let me go back real quick and pull this back up to the money slide so that we can ask the question. Loretta, you had a question on this, I think.
Yeah, because I'm looking at it as a whole, and then you went to the condos and they were higher in the days on market. So is this all single family homes and condos? It's everything.
Thank you. Yep. And I forgot, Wayne had actually asked me to break that out, and I sent it out last month, but I will break it out when I send this out again. This is condos and single family. So great catch on that. And you are correct.
Yeah, I appreciate it because there's a difference when you're talking to individuals.
Yeah, great eye. I appreciate that. And I will make a note to make sure we include both of those in there in future months. So thank you for that. Appreciate that. Yeah, you bet. Okay, let me dive back into Florida. Let's see. Florida itself. So we're kind of following a little bit of a different trend. Florida and Texas are kind of in the same boat right now. Currently, median list price is still on the way back up, 489,000. Average days on the market across Florida is about 150 days. So that is still high, but falling a little bit. Price decreases, we're at 38% of all listings have taken a price decrease, and we're sitting at about 91,000 total single-family non-condo listings available for sale. When we look at this on a month-over-month, we were down a little bit, 1.6%, and Florida has about 6.25% of all of the single-family housing stock in the nation, but currently we have 13.1% of the active listing inventory. So that number has fallen, by the way, quite a bit over the last 6 months. So we're back into a little more of a healthy space, but we still have a little bit disproportionately more inventory than the rest of the U.S. We take a look at this on a condo basis. Of course, the condo market is still being impacted heavily by the Keystone inspections, by insurance rates, by the the increase in the monthly maintenance fees. So we're still in buyer's territory here with a median list price of $345 and an average days on the market running at about 6 months to sell a condo across the state of Florida. Currently, there's 64,200 condos for sale in Florida. And if we just look at this on a month-over-month basis, we fell backwards about 1.5%. So just a little bit of people taking it off the market. Now, if we look at Florida as a whole and we look at what's our rate of pendings. So again, across Florida, we're above 2024 levels, but we're still below 22 and 23. And if you think back, those were some years that we had some pretty high sales pace rates here in Florida. We had a lot of inflow, but again, we're watching that a little bit. I would expect to see that really start to pick up as we get into the New Year's data. This was generated through January the 19th, but there's only a little bit of 2026 data that's actually in this trend line. So be interesting to see in the next month or two if that starts to re-accelerate. I would expect this number to be higher than any of those years by the time we get into May, June, and July. And that brings us down to our individual county level. If we look at Charlotte County still has a little bit of a saturation. So we are in a buyer's market in Charlotte County. Median list price, interestingly, continues to increase, 419,900. You're sitting at 180 days on the market, so it's taking about 6 months for something to sell in Charlotte County. Single family existing home sale, about 37% have taken a price decrease, and there's about 2,800 listings on the market. We look at the condo market in Charlotte County, we're pretty deep into buyers' advantage territory there. The median list price does keep falling to 70. 36% have taken a price decrease. You see that accelerating. So that's an indicator that sellers are trying to get ahead of the market. We're sitting at only 848 condos down there and relisting at about 5%. So we do see some inventory coming off the market. If we just look at the housing trends for single family, you can see we came off that really, really low level, June 11th, 2021, of only 282 homes for sale across the entire county. Today, we're at about 2,800, so we're about 10x, and that's a pretty common trend from the low. We're about 10 times the low inventories that we saw. Average days on the market, running about 180, and you can see this does continue to increase and go up from the low of 39 days in 2022. And really, June of 2022, that was a spot where things had gotten so out of hand. Interest rates started to go up very quickly, and that changed the dynamics of the markets. You look at Charlotte County and median list price, we'd hit a high of 529. Today we're at 419. And when we look at average price reductions, I said we're trailing about 36, 37%. Long term's about 34%. So there's probably a little bit of room for price adjustments still to be happening in Charlotte to get back into range. And it's not the 40, 45% that we had seen in previous periods. Again, you get a little bit of a sense of what's happening in each of the quadrants, each tranche, so the bottom 25% and up. Everything is trending pretty similar regardless of price point. Not a lot of disparity there. When we look at properties with price decreases, same here. Your bottom quartile has more of a tendency to take price reductions than the upper, but the range is somewhere in that 32 to 42% range. So it gives you a little bit of a sense of who's reducing and where there's some price sensitivity. If we come up to Sarasota County, we're sitting at 20. Our market action index is 29, so we're slightly in buyer's territory. This is a new change. Sarasota's been sitting in seller territory pretty much for the last 6, 8, 10 months. We've been flirting with this, but we actually moved into buyer territory this month. Median list price, Sarasota County, 549, with it taking 151 average days on the market. And there's about 3,229 listings. Now, when we look at this on the condo market, we are deep in buyer territory in the condo market. Median list price of a Sarasota County condo, $399,900. We've got 143 average days on the market. So we're running about 40 days less than Charlotte County was running. And we are 2,250 homes for sale. So if we just look at the trend line on inventory, you can see we hit that low in March of 2022 of 328. They were at 3,229 available inventory. So again, about 10 times the inventory. This is a little bit of a return to a healthy market. When we look at average days on the market does continue to increase for Sarasota County. So 151 days. And I think this is where the money slide is important, coupled with this, to see this is what it takes if we miss the mark, but if we price it right, this is what happens. 151 days. Sarasota County median list price trends. We hit a high of $699 in 2022. We're sitting at about $550. And I think it's important to note that it's not so much that prices went backwards. It's just that the asking price and the pace of price acceleration has slowed down. So we still are seeing some homes that sold at the really, really peak of the market. Those may be the ones that you see selling for a little bit less today than what they originally sold for. But as a whole, prices have still trended upwards, except for those that were bought in that really, really super hot, high part of the market. When we look at price decreases, we're at 39%. So Sarasota is still actively taking a little bit more price reductions than we would typically see. So that's an interesting one to pay attention to with your new listings. And you can start to see as we run into season, the upper end of that market, that $2 million and up range in Sarasota, is starting to accelerate on their median list price, while the other three tranches, they stay pretty consistent. So they're not moving very much. Price decreases. Not surprisingly, the lower end of the market has more of a tendency to take price reductions right now, and that's that little bit more rate and price sensitive buyer versus the upper end of the market. The range is 30 to about 47, 46% price reductions, depending on which section of the market you're looking at. Heading up further north, Manatee County, median list price in Manatee, 575.9. The average days on the market's 132 days, and that may be a little bit more of an indication of the fact that we've got a little more new construction there, and there's some aggressive pricing and aggressive rates being offered. But price decreases in Manatee County, 45%, so well over the 34% number that we would expect to see, and there's currently 2,340 homes for sale. We are still in slight seller advantage, and again, that may be an indicator that we still have a lot of new construction there, and that market is trending a little bit differently than Sarasota and Charlotte. When we look at condos, we're in buyer territory for condos. Median list price, interestingly, continues to climb, 299.9, 150 days on the market, and 1,306 condos available in Manatee County. So if we just look at this trend line, you can see we're, again, roughly 9 to 10 times the all-time low inventory at 268. We're sitting at 2,340 today. We look at days on the market. That days on the market has continued to climb, 132 days up from 32 at the low. So 4-5 months it takes on average to be able to sell a home. Then when we look at median list price, Manatee County, we're sitting at 575. You can kind of see that trend line. We haven't moved a lot. It's been pretty consistent the last roughly 2 years. Not a lot of up, not a lot of down. So that's an indication prices are still stable. Then let's see, Manatee County decreases. You're sitting at 45%. And you have to go off the chart to see this, but February of 2020, we were at 15%. So it gives you a little bit of a sense of how far we've come. So still a lot of price reductions happening in Manatee County, and probably an indicator of the little bit of softer market, which is probably why we're seeing those sales paces a little lower than the other two counties. Breaking it out into the 4 quadrants, you can see the median list price trends, kind of following that seasonal trend line in the luxury market, 1.5 million and up. But your other 3 price points are staying pretty consistent. Not a lot of increase, not a lot of decrease. And when we look at price decreases, again, just like the other 2 counties, that bottom quadrant, you're seeing a little bit more of a price reduction. In fact, 53% of the market, the first 25% of the market's taking a price reduction. So that's an indicator that people are getting a little bit aggressive on that more entry-level market. So with that brings us to Q&A, and I will stop the share, and I'll just kind of wrap by saying this. 2026 is shaping up to be a pretty good year after 3.5 years of the slowest sales pace in U.S. history. And when we think about it this way, the last roughly 3 to 3.5 years, there's been somewhere between about 1.2 and 1.7 million transactions that should have occurred that did not in the US. And what that means is we have almost an entire year of, I don't like the term pent up demand, but I'm going to use it here. There's about a year's worth of transactions that did not transact. And those are people that had life events. Maybe they had the birth of a child, they relocated, maybe they're renting, they had, they're cramped, they need another bedroom, or they need a home, they need an office, something like that. All those life events, we have an entire year's worth of transactions that did not happen. Those will catch up with us, and will drive the pace of sales up. And so the way I always explain it, it's like somebody just kinked the hose. There's a lot of pressure behind that kink, and when it unkinks, all that pressure is going to come out into the marketplace. So the message for your consumers is we're in a improving markets. Rates are improving. The economics of the economy are strong, and we expect 2026 to shape up to be a good year. For your buyers, one of the things to remind them is that right now, the sales pace is still a little bit slower. Rates are about where they're going to be for a lot of the year. So your buyers probably have a better opportunity now to negotiate more off the price than they will later in the year when the sales pace picks up, because as buyers come off the sideline, the market gets hotter, you'll have a lot more competition. So for buyers, rates are going to be stable, and it's a good time to negotiate. For your sellers, especially if they're a move up, what you give up when you sell, you're probably going to make up and then some on the buy side. So being able to understand that we can negotiate hard on the buy side still, especially depending on which county you're in. So if you take a little bit less of a haircut on the sale side, make it up on the buy side, and with interest rates low, you've got opportunities for rate buy downs or some things that you can do there to really make it take advantage of that. So get close to your database, build a moat around your relationships. And I think this is a really, really good time for you to be going through your database and doing home equity checkups, which is just helping the consumer understand what's the current value of their house and how much equity do they have. There may be opportunities in there to help them do refinances to bring down their cost, or they may realize that they're sitting on a nest egg and it's a good time to be able to make that move up. But communicate with your clients, make sure that you go back, take out the slides that are important to put into your listing presentations and your buyer presentations. And as always, if there's something that you want to see covered in a future session, don't hesitate to let me know. We're happy to put it in there. I will send out a copy of the recording along with the slides and a little bit of extra verbiage that I've got for you to be able to explain what's happening to your consumers. And with that, I'll just open it up to make sure if we have any questions or curiosities that I can answer for anyone. Now would be a great time. Feel free to raise your hand or come off mute. Silence falls on the crowd. All right.
Thank you very much for all you do. It's greatly appreciated.
Of course. Appreciate that. You're welcome, Loretta and Toy. Appreciate that. And we appreciate you guys. So go make it a great month. If you need anything, let us know. We're always here for you. See any member of the leadership team. And let's keep the sales pace and the activity moving as we move into February. Appreciate your time. Have a great rest of your day, guys. Cheers.
Cheers.
Thanks, Brian.
You bet.